in December, we're waiting. You have to anticipate what's going to come next and when things are going to move. So you got the year. In December, you're sitting there, you're waiting. You say, are they going to do LTR or not? If you waited for them to do the LTRO in Europe, and then you invested in December and you invested fast, you could make a lot of money. So we made a lot of money, on that first move. Then it comes into April. Okay, and you look in April and you say, boy, this economy looks like it's slowing. And a week before the Greek election, put vols were at 13. Okay, so this was the put side, not the call side. So put vol was at 13. So they basically said to me, we're not concerned about Greece. We're not concerned about the economy. Why don't you have these put vols? They're almost for free. So we bought puts. And so we didn't have a loss in that drawdown. Then we listened again, and we didn't have to, again, we don't have to be that smart. Okay, we're not that smart. Again, we get into the next time, and Draghi's talking about this, that, the other, talking about this put, and boy, he did. He gave away this put, right? And people not listening to it. And you know what we did when we heard about that? We got invested, and that worked too. And then we got into this election, and we said, boy, this doesn't look like the market's going to be happy about this election because Obama's going to win. Whether, that was right, wrong to be happy or not, that's what was happening, and they're going to be concerned about the physical cliff. And you know what we did? We took down our position again. Okay, now that when the market went down again, we said, okay, what are we going to do now? They're giving away call puts, call premium now. You get call premium traded really cheap. What should we do? Well, let's buy call premium. And that's what we did.
And
that's what we did, and we got a little longer into the end of the year.
You're just comparing call premium and put premiums versus put versus call premiums and calls versus put premiums.
Call vol. I'm sorry, when I say vol. The volatility of the loan, the price is being cheap. But we also got longer because the market came back down to 1350, 1360. So we viewed that as too cheap, given what was likely to happen. And our worst case has always been and continues to be that that they will do something like that Senate bill.
But that's where you stand right now on the assumption that D.C. will eventually figure something out. And as a result, the markets will go up.
Listen, this is the problem with the market. This is why you'll go down if you really want to go. If they want to commit political suicide and not do that plan B, which they all say they're going to do, and you have a lot of different ways they can do it afterwards, they'll do that.
But if they do that, you would just buy more because you think eventually
if they do it at that point in time, you really still have your 10 years taken care of.
Right.
Okay, and if the economy slows a little bit in the quarter, the money and everything else, people look right through it.
And these are S&P calls and puts that you're buying. Is that what you're?
I mean, we bought stocks and we took our position up, and we bought
S&P calls.
Can you give us a couple names though, just to make us curious?
If I give you names, you won't be curious anymore. You'll know the names.
Well, that's curious a lot.
I told you, if you want to talk about past investments, way back that we did in.
Well, I like what you just told us about the last year, because a lot of people are. I remember they said you got back in a lot of the banks and then you lightened up on the banks, and you never would really tell us when it was happening. Was that what you were doing? Remember when the banks got down? They were all like Bank of America was $5 and they were all down. You bought them, but then you sold. Remember there was rumors you were selling out of Bank of America at 9.
Well, listen, we had in 2011. We came in 2011. We lost a little bit of money in 2011. We came into that about as bad as you could possibly come in there. We were very long financials. We were along some of the other parts of the markets, mortgages and junk. And sometime through that year, we changed our opinion. I basically, called in and mentioned I changed my, there was a cautiousness at that point. And, we took down our whole book in 2011. If we didn't take down our book in 2011, we would have had a beyond horrible, horrible year. Okay, and so at that point in time, we took down our book to avoid that horrible, horrible year. I get fiduciary for my investors. I want to try to do the best job I can, and that's what we did in that year. So that was then. So.
Okay, but in general, so you do a lot of different things. But if you do want to get long, you'll do just S&Ps. Is that what you do? If the volatility.
What we do with our book? Okay, Appaloosa has historically
buy a lot of them, huh?
Appaloosa historically has a lot of long-term gains. Okay. Appaloosa historically, it was like 50, 60% long-term, okay? So that means we hold things. Now, given that some markets are less liquid, we probably have 60% of our book, or 70% of our book in bonds and stocks and different things like that. And we'll move them up or down based on the individual names, right? Okay. And then we'll use stock futures or options or bond futures to kind of, get more invested or less invested at different points that we like, so we can move the book up and down or sell the book. So,
right, so when you see low call volatility, you might be buying individual stocks. That would cause you to buy individual stocks.
Well, we would buy individual stocks because we like the individual stocks,
Right.
because something's happened.
And then you might add to it
with
options and S&P futures as well.
We would, in the whole market, if we thought the market was cheap, or we had, if you have a situation, okay, you have the Greek election, you don't know how the Greek election is going to turn out, but the vol is cheap. I don't know what's going to happen, but I know the vol's cheap, and it's either going to be good or it's going to be bad. And I can only lose a premium if it gets bad. And if it gets good, I'm going to make a lot of money. Now I can buy. Now I don't know where the premiums are today, but in options I can go. I'll be right or wrong, and they'll do it. Now I'll minimize my losses, because if they really don't get it right in DC, the market will go down, and I won't lose. And if they get it right, I may not be able to, in this particular situation, I may not be able to get invested fast enough, is my concern.
Right.
Because we're pretty big. So that will get me invested. And if the worst case is I lose my premium on the other side. So that's the strategy right now when I have low vols. Okay, when I perceive the vols low for the event. The question is the vol, some other people made the vols not that low, but I think in this particular case they were.
Given the rest. If most of your stuff is long-term holdings that you have, did you change anything based on the idea that capital gains taxes are going up one way or the other with this fiscal cliff issue? Did you change in and out of positions as a result?
We basically have, taken a bunch of our long-term gains this year to lock in these lower rates for our investors. That's an easy thing to do in the market. The government lets you take gains.
Right, you lock it in at 15% versus 23
or 23%, whatever it is.
44, whatever it's
I mean, it's kind of common sense to do that with some of your gains. Right. I don't know if you do with all, but you have to do with some of them. So, if you want to ask me about individual investments, Andrew, you can ask me in 2008, 2009, and Lehman, or I know you're a big Lehman guy, so sort of time period.
I'm not going to push you on those. I was just